Hello and welcome. I'm Patrick Curtis, your host and chief monkey, and this is the Wall Street Oasis podcast. Join me as I talk to some of the community's most successful and inspirational members to gain valuable insight into different career paths and life in general. Let's get to it. In this episode, I'm joined by Carter Malloy, CEO and founder of AcreTrader.com, a site where you can easily invest in farmland. Prior to breaking out on his own, Carter spent 5 years at a long-short hedge fund and over 7 years in equity research at Stephens. Learn what he liked most about equity research and investing, as well as why he eventually decided to start his own company. Enjoy. All right, Carter, thanks so much for joining the Wall Street Oasis podcast.
Thanks for having me.
So it'd be great if you could just give the listeners a short summary of your bio.
Absolutely. So I grew up here in Arkansas, went to school here as well at the university, graduated with my undergrad in physics, spent a few years playing music and owning a few small businesses. Did 7 years of equity research on the sell side, and then another 5 years on the buy side at a long-short equity fund. And then for the last couple of years, been focused on AcreTrader, which is the company that I'm really excited to talk to you about today.
Very cool. So in terms of just going back, I'd love to just jump into undergrad. So was physics always a passion of yours, or what did you were you ever thinking finance as kind of your first, or one of your, I guess you didn't do finance, you were a small business owner. I'd love to hear about that. And what led you there, and then specifically what got you into equity research?
Yeah, for me, the goal, at least at the onset, was always to own my own business. I think there was a moment there where I was confused and thought I wanted to be a doctor. And so had been studying biology in school, and then switched into business, and then ultimately decided, look, I'm going to work for myself forever, which did not come true. But I considered I was going to work for myself for a long time. And so just wanted to study what I'd found the most interest in school, which at that time was physics.
So why did you feel like you knew you wanted to work for yourself? I mean, eventually this is now true. So you are working for yourself now, but it took a while to kind of get back there. So what drew you to the entrepreneurial lifestyle or life?
I think I was mostly lucky in that my parents were both entrepreneurs. And so I grew up in an entrepreneurial boom and bust type of household, lots of job changes and lots of new business ideas being pursued.
What did they do? What types of business?
Banking, oil exploration, like wildcatting oil exploration, nothing sexy or anything fun like that. And then my mom had a candy business for a very long time, actually.
Very cool.
And
okay,
so about a half dozen other pursuits in there as well.
So when you came out of school, what was your first endeavor? Did any of them do well, or was it kind of struggle after struggle, or what was that like?
Yeah, the primary focus after school, I'd been playing and touring around in a band, and we had a diesel, basically this big van that we drove around in.
What did you play? What
guitar mostly, and nice. Then keyboard as well. So we had this van that we drove around in, and had converted it to run on vegetable oil, which sounded like this kooky idea, but in reality, we'd literally pull up to the next town we were playing in, go eat some Mexican food, go out back, ask their permission, go out back and get their used vegetable oil and travel around for free. And when you're in a band living on ramen noodles, that tank of gas is pretty meaningful. And so we realized at the time, hey, this could actually be a business helping other people to do this. And so turned that into a business, and that went well for a few years. And then we ultimately exited to a group of local entrepreneurs.
How do you turn a business of vegetable oil fuel into is it the type of engine or something that can handle it, or what were you?
It was just a secondary fuel system, basically. So new fuel pumps, new fuel tank in the car to help propel it along. So pretty straightforward. A couple $1,000s of alteration, so nothing crazy. But at the end of the day, what that meant is I was a diesel mechanic, or a fuel systems mechanic for a few years.
And so, where did you tour with this van? How many other guys or gals? A couple?
Yeah, there was 4 or 5 of us total, usually, plus a couple, friends running lights or soundboard or whatever. And anywhere from New York to Chicago to Colorado was sort of the boundaries, I guess.
And you did that for 2 years.
Did at the end of school and then out of school as well.
So then, what? It seems like a complete 180 to then go into equity research. How on earth did you manage that? And what drew you to that?
Freak accident. Had a friend of a friend that worked at a reputable firm called Stevens, very well known sort of off Wall Street private investment bank, and very conservative in nature, very well run organization. And so it was sort of a storied company I knew about growing up, and had a chance opportunity to go take an interview, and so bought a corporate finance textbook, and probably the only textbook I ever read cover to cover, but chopped through it and went in thinking, I hope, now I know what EBITDA is. I can talk to him about this. And, and really they just wanted to explore for research. I think the things that people look for most are, do you like to go learn new stuff and go dig around in industries? And that to me really was exciting. And I think, the most fun part of my career there was I got to go, be in a library every day, basically.
Were they the types of questions I assume were more around like, what do you like to do? Or were they more fit and behavioral kind of things to see if you enjoyed that? Or was it like,
yeah, I all the above. Look, and
did they ask you to pitch a stock, I should say?
They did. I failed terribly at it.
You still got the job, but you still got the job.
I did. I interviewed with several research analysts. The first one, great guy that was looking for somebody with real chops, and I definitely did not have them. And so it was about a 15-minute interview. The second person was an internet advertising and digital marketing analytics type of analyst, and I had as another business that I didn't mention earlier. It was a flaming failure. Was a website centered around digital marketing, and so I at least had some understanding of industry fundamentals to visit with him about. So that was a 2-hour long interview, and I think at the end of the day we got along well as people, and that matters most probably when you're interviewing, and both on either side of the table, I should say.
So it turned into a long interview, more like a conversation, and that was kind of all that was needed. He was like, I want him on my team, and your career was your finance career was launched.
Yeah, I got lucky, but I think I always remembered, and as a team we worked really well, and so in interviewing others throughout my career, always made sure to really pay attention to personality and fit and curiosity, creativity, the things at least in equity research in particular that matter more than can you build an Excel spreadsheet on day one.
Were there certain things you would ask to try and get at that in terms of like curiosity specifically?
There are, and I still do. I want to learn what people do outside of work, and outside of school or outside of their career. And in finance, you ask people, what are the last few books you've read, for example? They'll always name off, the top 3 or 4 investing books or critical thinking books. And that's cool. Like that's really great that people have that passion, but you want to know that they have other passions and other pursuits as well. And so maybe, typically I'll ask people like, what's the last thing you dug in on Wikipedia about? Or what's the last topic that you became interested in that was not purely finance or purely related to this job?
Right. Interesting. And do people struggle with that, or now not so much because now they have the intersection and they talk about?
Some do, and if they struggle to tell you what they're interested in or what they like, that's tough for me. Even if like the person genuinely loves finance and they love crunching numbers, like that's great. But in the world of equities, like you've got to also be interested in people and be interested in businesses and sectors. And so if you love finance, that's great. But like, tell me about the last time you dug into natural gas markets or oil's future contango, or you pick the industry and the problem, but you just want to see people that, they have a passion for more than just purely like the CFA questions.
For sure. So it makes total sense. So you had a really long run at Stevens. You were there for over 7 years, eventually managing director there. Tell me about that progression. What was your day-to-day like kind of when you first started, and then how did it evolve over time?
I think out of the gate, I found a strength in that I really liked Excel and liked macros and, cutting corners. And, as I know you talk about a whole lot, it's really, really important core skill set. So I focused a lot on that because I sucked at writing. And so that piece of writing took me a lot longer to figure out how to convey a complex thought into a sentence, or really ultimately more importantly a picture. And today and as my career progressed, I really moved away from trying to write eloquently to let's do this with crayons. Can we take some complex theme or some complex industry and boil it down to a slide or two with pretty pictures.
Interesting. So you kind of tried, instead of trying to write eloquently, did you have an analyst above you that would help with the writing, and you were kind of doing a lot of the analytics in the background and the graphs and the.
Thank goodness, yes.
Yes.
He was, very focused writer, and so our skill sets complemented each other pretty well.
That's great. So what after you had a really great run? Where was that? What was the office for Siemens?
In Little Rock, Arkansas, which is where their primary office is. It's a couple thousand person iBank, so they've got offices all over, but headquarters and probably half or more of the employees are
you were there
out in Arkansas.
Okay.
That's right.
Rock. Okay, and so tell me a little bit about kind of the evolution of your thought process as you kind of approached that final year, or maybe even final 2 years. Were you thinking, hey, I want to go start something on my own? Or at this point, had you started kind of playing with that idea, or were you thinking, no, I want to go buy side and start actually, practicing or seeing what I can handle as an investment professional?
The whole time I was there, I still today, I don't know what I want to do when I grow up. So, it would be unfair for me to deny that I thought about other things, but in reality, like, I loved the job. I liked the people there. It was a really cool place to work. And so liked my boss, his boss, the guys all around me on the floor. So it wasn't that I was out seeking to leave, because I loved the process and the industry we were in and what I was doing and the people. So it really came down to, I'd spent a decent amount of time on the short side on short selling and had made friends with a few fund managers that focused on that. And, one of those ultimately said, hey, we're thinking about starting a fund. Would you like to join us? And again, it was a people bet far more than it was anything else. I really like these people, still do. Like, they're the guys I went to work with at the fund are still close friends. But that was the big deciding factor is I can enjoy this because I get to do what I want, and I'm surrounded by good humans.
How did you make that determination? Just through, was it a long conversation, the courting process of trying to get you to come join them? Was it like a year, or was it 6 months? Tell me about that interview / why did they target you specifically, number one, and then why do you think? And then how did you get comfortable with the fact that this is a startup fund, there's some risk here?
There's always risk, and I kind of like risk, and so that was the whole thing was an easy decision. Let me be forward about it, because it was just a new thing to go do. Moved out to where you are in San Francisco, and had a really great 5 years there. And so the interview process was fairly straightforward. One of the guys that I was close with, he and I had worked really closely on a number of stocks, so that was pretty straightforward because we knew each other. The other one was this very intimidating engineering mindset type of person who turned out to be a lovely human as well. But he did dig into me and show me what you can do, and ultimately a case study is the thing that it rested on in an industry I knew absolutely nothing about. So that was interesting.
So tell me a little bit more about that. Did you have to? Was it like here's a case in 24 hours, get it back to us, kind of thing, or what was?
Yeah, it was probably a week or two, and it was financial services.
Oh gosh,
type of business. And
so incredibly difficult, like, cause like everything's different.
Yeah, they had 6 different business lines, and tons and tons of countries and all that fun stuff. And so I did in that case what you should always do, which is phone a friend. So start picking up the phone and calling people to ask them their opinions on it and how they'd go about the analysis and how they think about it. And that was the project.
And so
how
did initially you said I had worked with this person on stocks. Was this somebody in Stevens that you kind of broke off with?
No, the 2 fund managers I went to go work with had previously worked at a large West Coast hedge fund.
Got it. And so they were breaking off, starting a new fund, and they identified you through, it's probably your research, right? They'd read it.
That's right.
And liked it. Okay. So real quick, before we move on to the long short fund, what about equity research in terms of like, as a career now? What if you had to say something to the younger listeners? Do you feel like it's still a good place to be in terms of? I know there was some pressure on it, but some people still just love that job, that idea of going to the library, like you said, and learning about different sectors. So what would you say to those people?
Yeah, I think the industry has some secular challenges. I think the industry has. I don't think that the industry has fee compression. Find me an industry that doesn't exist. They're rare,
Hmm.
and so that's the nature of the beast. And as long as you go in and you work hard and put your head down and put out good, thoughtful product in whatever sector of a bank, for example, that you want to go work in,
Yep.
you should do well individually and have a good time at it.
And how about pay? Do you mind sharing a range of pay from, you know, going from, all the way junior coming in? Obviously, you're in Little Rock, so the cost of living is super low compared to New York. But like, just to give people an idea of like how you progressed over the years there, and then at the Long Short Fund, obviously in a much higher cost of living area, I
Mhm.
assume the pay jump was pretty significant. But if you could just give us an idea, it doesn't have to be exact, but just a range from like how it scaled, so they get it.
Yeah, it's out of respect and privacy for the bank and the fund. Unfortunately, I'm not going to disclose the pay. What I will say is
Hmm.
the great thing about the industry as a whole is it is pay for performance, right? And so I was lucky to have good performance first, and then lucky to see my pay.
Even on the equity research side, like how did they measure your performance just based on the calls you were making and stuff?
Yeah, there was a grading matrix, calls
Okay.
and management trips and stock performance and buy side votes. So I think that.
So they were measuring, there were actual metrics they were measuring on, and you had a bonus tied to that specifically.
That's right. And I think most banks have, at least some, if not a majority of equity research compensation based on objectivity.
And
There's always subjectivity, no matter where you work. There's
well, yeah,
always,
I mean, I know for like bankers coming out that are in like M&A or coverage bankers, their comp can be 100% of it or 50% of it could come from bonus, right? And so I'm just trying to get an idea. I know very little about the equity research world because I wasn't in there. Is it more like I assume it's a much smaller bonus, like a 20 to 30, up to 30, 40%, something like that on
I,
base? Or, or could it get
for
all the way up?
my journey was at a point was probably that, but as a whole, throughout my career, I think the bonus was definitely the majority or large majority of
Oh, okay.
compensation.
It
So
was. Okay. Very cool. I think that's awesome. I think it's better that way.
I totally agree.
It
And
rewards performance.
I'm happy to take low upfront compensation and trade for eat what you kill.
Yeah. And so that you were that's a good transition, I think, into the long short world where that's even more the case,
Mhm.
where I feel like the upside is definitely there. As kind of an early founding employee, we'll call you, were you, you don't have to share this, but were you given any carry? As a pretty junior, I mean, well, you weren't really junior because you were 7 years, 9 years actually out of school at that point. Um, so did they treat you like that? Like, how should people think when they're going to a new fund, negotiating something like carry or bips?
Yeah, the range is very very wide, and there are compensation studies out there on the industry that will show you just unbelievably wide ranges in terms of what analysts or partners or PMs take home, and it's unique to every fund, but as a whole, again, what matters is you show up, you work hard, and you perform,
Hmm.
and those things tend to work themselves out. With a caveat of you should also make sure to work at a good fund with good people, and I would put the people way way in front of the fund. So to me personally, dramatically more important to work with people that you like, because
Hmm.
you're seeing these people more than your best friends or your
Your
wife or
family.
husband or your family every day, all day. And so that's the thing. At the end of your career, it will, no matter what's in your pocket. What matters is what the journey was like, and did you have fun on the
For sure.
journey? And so
For sure. And so in terms of Stevens, you were loving it there. You love the people there. What got you comfortable enough to kind of leave that behind? Was it obviously the people, but like, did you feel like you had enough time? So you had a couple week case study, but was it like a long court? Was it like a 6 month process or was it like a 2 month process? Tell me a little bit about that. I mean, obviously you had some people you had one guy grilling you a little bit, and the others just being a little more cordial, but I want to hear just so people can understand. And then were you interviewing them a lot? Like, were you pushing back on specifically what their strategy was? It sounds like these people had great track records, so there's a little bit of comfort around that. But can you talk a little bit about that?
yeah, I think, and I know it wasn't intended, but pushing back isn't a word I would use. I wasn't grilling them, but I was definitely interested in how they, how they made the magic, right? And how the sausage got made every day. And what it turned, what I learned is it got made through a really, really intense and very deliberate process. And that was the piece that got me the most excited. And frankly, the most comfortable is the fund had a structure and they had an approach, and we never, broke that or went around that. And as a result, things tend to work out when you do what you set out to do and stay true to your laurels or your plans.
And tell me a little bit about the transition. So when you made the jump, was it tough to kind of switch into that rigorous process, or you feel like what had in equity research had prepped you really well for that long short?
I think the process is the same. The product differs. It's altered somewhat.
Doesn't have to look as pretty. The writing doesn't matter.
That's right. But at the end of the day, the core function of the job, go understand an industry, a company, a management team, incentives, potential outcomes, and build a financial model and some sort of presentation or summary of that. It was always the case in both jobs. And in fact, at the fund, I mean, that ended, every investment was backed by a 30 to 100 page investment memo. So we put together very real PowerPoints ultimately.
And so were these, was it more like a long short fund where there are fewer positions, but more concentrated and heavily researched?
That's right. That's right.
And would you say that when you first joined, were you like one of three people, like the two founders and you, or was it, so really, oh wow, so it's really small?
Yeah, and then we another great person and close friend joined just after I did, so very quickly there.
Okay.
And then we hired analysts, call it 2 to 3 year analysts through, and continue to. So
what about like your day to day? So obviously you were doing a lot of heavy research and getting those reports written so that you could make a decision. But I'm curious, like when you got to the end, so like you spend all this time, what if you get to the end and you don't feel very strongly in one direction? You feel like it's pretty priced, the securities are priced pretty appropriately. Do you have to start all the way back over again? And how many times are you doing that before you feel super strongly about a specific position?
Yeah, if you get to the very end and you don't love it, then just don't do it.
Just don't do it.
Set a price, right? If you decide you love the company and you want to own it at some point, or inversely, this thing is got some real hair on it, some problems.
Yeah.
But you don't love the setup, then you set targets. You write it down on paper. I think that was the really important part for us of creating these ridiculous slide decks. Was you had to memorialize your thesis, and so you couldn't lie to yourself later with thesis creep. Like we all suffer from it. It's a human thing to do, and so I continue to do it all the time, despite dozen years plus of trying not to. But that's the important part is at the end of that process, if you don't love it, move on.
Very cool.
And if you don't love it halfway through, quit, and stop working on that one and move on.
But yeah, what if you're looking for a short though? So if you don't love it, that's a good thing. You keep going.
That's right. Well, if you don't love the investment.
Right, the idea. Of course. So you're kind of going through this. What would you say in terms of the percentage of all the work or the ideas you looked at actually became positions you put on?
A small minority. I think rarely would you,
something like that.
Yeah, if that. I mean, rarely would you get all the way to doing a full month's work, and then at the very end of that say no. That certainly still happens, and that's a good thing. But usually after a day or two of reading transcripts and calling pool equipment distributors or whatever it may be, and realizing, okay, this actually isn't as exciting as I thought, then move on. Because time is your most precious resource.
Very cool. So it sounds like you had a lot of success there. AUM grew significantly. Obviously, an initial fund isn't that big. Are you able to share kind of what the initial AUM was for the first?
Yeah, initial was I think it ultimately out of the gate or pretty early in its life in the first year, so it was in the hundreds of millions.
Okay,
then scaled up effectively from there.
Great. And so you were there for a good 5 years. Sounded like you had a lot of success. You guys were doing well. What prompted kind of the finally to put your stake in the ground again and go to the startup route again?
Yeah, a couple of things. One was family. I'm from here in Arkansas, and I had a dad in rather ill health, and he's sort of my best friend, and so wanted to get closer to him. So that was a big driver for me. Beyond that, my dad and I historically bought and sold a bunch of farmland together, and I had a neighbor come to me in San Francisco and say, "Hey, I would like to buy some too." And it's like, "Well, we'll go online and do it. It's a multi-trillion-dollar asset class, and it's put up incredible historical performance." And uh, went looking, and there was nothing there. And so there was an aha moment of, "Hey, here's something that when I do move home to be with my dad, we can work on together." Because he's a backstory. He's also a farmer. I said banking and oil earlier, but primarily a farmer.
He must love
And
this,
so,
working with his son.
yeah, we're having a blast.
It's amazing. So tell me about the exit though from the long short fund. Was it? I obviously it was reasons with family and all that stuff. So I'm sure they were understanding. But was it ever? Do you ever feel like you could go back if for whatever reason things don't work out, or you want to get back in? Do you ever have that fear? Because I think some people have that fear when they jump.
Yeah, if I wanted to go back, and I always do. I mean, I miss it every day, and so if I wanted to go back, I would hope they would have me.
Yeah.
Is the way I would put that. It was a very amicable separation, and I was very lucky to work with good people, and so they fully understood the situation. So
For sure. And then so for specifically in terms of how you kind of did this, had the setup, you said you had that conversation of you had the aha moment when you went to look for, okay, well, where can you buy farmland online? And it really didn't exist for this multi-trillion-dollar asset class. Was there a lot of homework that went into like getting things ready and prepped before you jumped? Or was it like, I'm just going to jump, I'm moving to Fayetteville where it's the cost of living. I've done so well, I can just relax and I don't have to worry about it. I have a good runway here to make this thing work. Or what was your thought process? Because people freak out like making that jump. You had a big advantage of going to, obviously back to where you're not living in San Francisco anymore and, Bay Area. So you're not spending, $4,000 a month on an apartment, but,
right.
Tell me a little bit about that.
Yeah, I think the two were fairly independent. The idea of moving home was definitely concrete, and the business was second to that.
Mm-hmm.
The business has now become, very, very focal in front of mind, and what I spend most waking hours doing, but having a blast working on it.
So tell me about that. The initial days. It's been about a couple of years since you started it. Tell me about the evolution of AcreTrader. What happened with the initial kind of first few months as you started kind of the brand? And I love the branding. I love the name, by the way.
Thank you.
Very well done. Tell me a little bit about your first few transactions and how you even got it up and how you started getting the inventory and the difficulty of a two-sided marketplace. Why don't you give people just a little summary of what it even is so they know?
Absolutely. So AcreTrader is a real estate investing platform. So it just makes it easy to go online and buy shares of farmland and earn passive income. You can literally invest in farmland, starting with $5, $10, $20,000 in minutes online. So we've built a platform on the same rules as crowdfunding, basically, to allow people to come get access to this asset class, which we're convinced is pretty incredible.
Do you still have to be accredited to do it, or are those rules changing soon? Or
yes, so you have to be accredited today. The rules of the definition of accredited is evolving positively for investors, and especially for people that are in the investing industry, to include them even if they don't have the threshold of income or net worth. We are also
is that the Jobs Act.
That's correct. That was what initially created this, was the Jobs Act.
Yeah.
In summary, the Jobs Act made it more approachable to securitize smaller assets. So
right.
if you wanted to previously securitize something and go raise money from people you didn't know, it took hundreds of thousands of dollars in an S1 and going public to do so,
right.
and or other wildly rigorous situations. And the Jobs Act just reduced the barriers so that you could go out and raise capital for $1 million a piece of property or business or whatever that may be,
from thousands of investors.
That's right. That's right.
So, but tell me, are they still not allowing non-accredited? Why are they not allowing that? I thought that was patent from, there's like WeFunder and these other startup ecosystems that are doing this. So tell me why that still isn't allowed.
There are different components of the Jobs Act and different exemptions from regulations that you can operate within. Uh-huh. And so the one that we and most that we see most of the larger crowdfunding platforms operate under are what's called the regulation, or the 506C or 506B exemption from Reg D. So those are accredited investors, or very few non-accredited. There are
you are able to advertise.
That's right. There are other alternative structures. You may have seen Fundrise, for example. That's basically a REIT, an E-REIT. And those can be marketed with pre-registration, so upfront investment and time. Those can be, can allow in non-accredited investors as well. And so we're working on a product in that realm to bring on non-accredited investors. We did not set out to only make farmland investing available to accredited investors.
Got it. Okay, so tell me a little bit about just initially the early days, the first few months, and then tell me how it's evolved.
So early on, it was about building an MVP. So, I did a bunch of survey work, through Google and SurveyMonkey to go understand investors' appetite for farmland, for the specific asset class we were working on. And what we learned is there was a ton of interest, but people didn't know what farmland was. Like, why would I invest? That sounds awful and boring. And I think with a little bit of education of, here's this long-term compounding asset class returning, that's returned about almost 12% a year for the last 30 years in a highly consistent, unlevered, low volatile manner. Once you show people a few charts, they go, oh, wow. All right. How did I miss this one? And so I think, one was really about building proper educational materials. Obviously, you never overpromise. You want to make sure to be crystal clear as to, how things are built and what the understanding you're providing people of an asset.
Can I stop you for a second? You said the 12% return is a lot of that the capital. How much of that is really capital appreciation versus the cash flows of the farmland return?
It's been roughly 50-50. I think it leans a little heavy to appreciation. So you nailed it. You make money two ways, right? The asset appreciates, or has always, or has historically for the last 30 years appreciated underneath you. And then on top of that, the farmer pays you rent, so you get some cash income a year. So the combination of those two are roughly even, with appreciation maybe kicking in a little more.
Got it. Okay. Sorry, I interrupted. Keep going.
No, great question. It's fun getting asked those types of questions. It's all we think about every day. Is farmland. So the early product was, build something to educate people and build something that's easy to use. Both of those are really hard to do. It took us some time. Built an MVP, which is a minimum viable product. So here's the basic technology. Put it online to see if there's interest, and hey, there was a lot of interest. People were pumped about it, and so then it was, all right, we've got the interest. Now let's go take some real time, raise some capital, and build a real product before we truly roll this out and launch it, which we launched just about a year ago now. But we spent an inordinate amount of time making sure to get our systems right, our security right, the ease of use correct. We're dealing with people's money at the end of the day. It's a pretty emotional thing. If we screw that up, we're not going to be around for very long.
So tell me a little bit about the fundraising process and what you had to show in terms of traction or interest that got investors comfortable enough to write a check. Was it would you consider it like pre-seed? And obviously you didn't need a $10 million round necessarily to get to the, from MVP to the first launch, but to beta, but I'd love to hear about that.
Yeah. So, and we are in process of closing a larger investment round today that we'll be out talking about soon and are excited about. But for the early capital, we used a safe round, simple agreement for future equity, which acts like convertible debt, basically a really simple 6-page convertible note, if you will, without a coupon or a lot of the other
just a discount,
difficult features. That's
just
right.
Some sort of discount.
A discount or a valuation cap. So we chose to provide our investors both, so that just to make sure they were in at the right place. And so let's see. So we went out with that to go raise money. It was really execs in agriculture and technology and banking that I'd worked with over the years that provided, luckily for us, provided some of that early vote of confidence of, hey, we see the addressable market, we see the product market fit, and so we're interested in playing a part in this. Since then, we've got to show some real traction, and so we've been grinding away here for the last year since launching it, at getting that to occur, and we're now in that hockey stick period of execution here. We've haven't moved, but transitioned quite a bit from build to, oh my gosh, now we've got to think about managing all of this and
volume,
scale it up, right? And so it's been a really fun exercise, and we were lucky in that we just got an incredible team of people here that are all thoughtful about processes and scalability and automation. And so we've so far so good.
That's awesome. How big is your team now?
Just we're approaching 20. Not all those are full time.
Yep. And have you been able to? I guess is it heavy on like the developer side still? I assume.
It almost half is development.
Yeah, it's like it sounds very similar to my team.
Yeah, exactly. And I walked into this knowing exactly nothing about software development. In fact, today I think I took a Python class, when I lived in San Francisco. But
yeah,
but really, it was for finance, and still have very little development chops. So
has that been the hardest part, as being a non-technical founder, kind of just finding the right developers, or how did you even find them?
Yeah, again, I got lucky, and I know I keep saying that, but it's been a good.
I don't believe it anymore. I don't believe it anymore.
It was pretty simple. So I, sort of built this business plan, built a slide deck, went and hired some legal counsel to help navigate. Is this actually doable? And come to find out, it was very hard, and still is very hard to make sure we do everything exactly right per regulations, and some of which are not exactly black and white. So we just decided to never get in the gray area. So that took a while. Then as I was fleshing that out and running the idea by some friends, went out and looked for a developer. And so built a list of 100 websites in fintech that I liked. Then went through that with a fine tooth comb, and just Excel, right? So then you rank them, you go through the fine tooth comb and say, all right, here are the top 20. Went and found their lead developers, either on the website or through LinkedIn, and just started cold reaching out to those people. Boiled it down to 5. One of them really, really liked, and we got along well, and he was clearly very good at what he did. So that was that. Hired him.
And he was like, he's kind of the CTO, lead developer.
That's right. He's the lead developer or product manager is what we would call him. So.
Got it. Okay. So I guess, well, given that it's like almost like a two-sided marketplace, right? You need the land being listed, and you need the buyers coming in to purchase the land. There's always one side tends to trail the other. Sometimes it goes like this, but what has kind of been the path so far? I know it's been kind of only live, like publicly, for about a year, but what have you seen?
Yes. So the demand side.
I guess wrong, by the way, the first time I talked to you.
They're all a challenge, right? Where it's really running two separate businesses that are the same thing, or depend on each other, I should say. The demand side is pretty focused on marketing and data science, right? It's about customer acquisition cost and lifetime value, and the relationship between those two metrics, and going out and getting the message out there, and doing so in a capital efficient manner. And again, there we've got just really great people focused on that problem every day to go out and solve that, and let the world know that we're here. On the supply side, it's much lumpier. It's pretty reliant upon relationships and making sure that you're doing the right deals in the right places. And so that is run by a guy here named Garrett McClintock. He previously managed a few $100 million of farmland, so knows. I'm a redneck, but this guy knows dirt in a way, or soil in a way that I never will, and his team for that matter as well. So they're focused every day on going out and finding farmland. And at this point, we're speaking to hundreds of farmers.
And is he? I'm curious. Is he an employee of you, or is he a partner? Or how does that work?
Yeah,
employee.
We're all employees in the day. He's certainly a stakeholder. Everyone here is a stakeholder in the business. So.
Yep. Very cool. And so the goal here is it's like you said, you have a lot of runway, or a lot of do you feel like you're going to be able to, is there a certain point where you see where it's profitable, or are you already profitable? What's the kind of seeing kind of how you're scaling is there a good runway there?
There's great visibility on profitability. Our unit economics are good. I think as a young company, and especially in a network business model, we want to grow quickly and grow responsibly. And so thus we are okay with using some additional outside capital and running at a net loss for a time to scale it up faster. Again, in a responsible way. We know without a doubt if the investors on our platform do not have a good experience, or if the 1 in 100, 1 in 200 farms that we put up there is a bad investment for them, we won't be around for very long. And obviously our intention is the opposite.
So do you feel like there is risk around timing? So like as you scale, let's say for whatever reason, the asset class, I don't know why this would happen, but there's drought or there's whatever have you. And a lot of them, maybe instead of 2 out of 100 turning into negative investments, it's 20. Does that keep you up at night? What keeps you up at night in terms of, is it that? Is it something else?
Yeah, I think, and I want to return to the negative of the investment, but for us as a platform, it's also making sure we have investments on the platform.
Right.
And we've decided, and if I were to show you our chart of momentum of fundraising on the platform, you'll see a couple flat points. We went 3 weeks in December without a single listing. We had several right there at the edge, about to put them up, and found a small problem we didn't like. And so, we would rather forego the revenue than have our investors have a bad experience. As a result of that offensive level of diligence and underwriting, as we've talked about diligence earlier, I tend to be pretty, pretty forceful with it, as is the rest of the team here. As a result of that, we do hope that our farms perform very well over time. Mm-hmm. Interestingly, in terms of the asset class and downturns and what could cause investors to lose money, like they absolutely can. They know that. What's fascinating is we're usually going in without leverage. So you don't have the amplification up or down in terms of returns. It's very difficult to imagine a scenario where with no leverage, a piece of productive ground suddenly becomes not productive. Aside from somebody dumping a bunch of barrels of nuclear waste, it's tough to come up with that scenario.
Right.
But bear markets do occur, right? And so the most recent example of that would be Nebraska, and I'm going to botch the numbers here, but roughly. So Nebraska.
I love this stuff. It's super interesting to me. Just like hearing about this asset, because you're educating me, and you're probably educating a lot of the listeners as well. Farmland, so it's cool.
it's fun stuff, and a lot of this, all this information, and then orders of magnitude more are on our website at AcreTrader.com. So you can always go as much as you want to read. We got it there, and call us anytime. But the bear market story, Nebraska. So through 2014 or 15, they had this massive run up in land prices there, 100, 200% jump in prices. And then from 14 through 19, there was a 5-year downturn in prices. One, because there was heavy speculation. Two, because people in many parts of the state shouldn't have been buying farmland anyway, because it's sitting on an aquifer that's drying up. Something that, we wouldn't have pursued, wouldn't have even opened the file on. But there was a lot of capital that came into the state very quickly.
Why?
So good returns was the big one.
It kind of fed the good returns, fed more returns kind of thing.
That's right. So the yields were really good for a number of years, even in the bad places. Yeah. And then commodity prices were really on a tear, through 2014. And so people were making hand over fist. So farmers were buying their neighbor's farm. Investors were coming in. More farmers were buying their neighbor's farm, which was really the big driver there. Mm-hmm. And so after this huge run up, you've since seen a bear market. And it's the best and most extreme isolated bear market that we can find in the data in the last 30 years in the US. I keep saying 30 years. It's because it's the time period through which we have the best
data
measuring stick and information. And I can go back to another bear market if you want to further delve into the.
Oh yeah, tell me, what was another one?
But I want to finish up on Nebraska.
Yeah, sorry, go ahead.
So 14 and 19, 5-year bear market, prices came down 17% end to end. Sorry if I script the numbers, but we're roughly on point. End to end, on a nominal basis, the investors still made money, because even though the prices of the land came down, you were running with no leverage, and on the other side, the farmer was still paying your rent check every year. Mm-hmm. So you had a cash yield in pocket. So you sell the land today at a 17% loss on principal on the core asset, mm-hmm. but you had made a 20% give or take on the cash rent, 4% over 5 years, and so end to end, you in that bear market still came out okay.
Yeah, it's so interesting. Yeah, I mean, so tell me what what's going on with institutions? Why aren't they? It's just because it's too decentralized. Too what do they call it? Scattered. I can't remember the word.
Yeah, it's
you know what I'm saying.
It's part of it. I think
there's no roll-up strategy here, or
there is, and so interestingly, they are here. Pure institutional capital, so private equity capital in the last 10 years has gone from $3 billion of exposure in farmland to $30 billion.
Okay,
still tiny. It's a $3 trillion asset class. So
right,
a point of it is professionalized now.
What about in the U.S.? How much is that in the US? Heavily?
So yeah, globally, farmland's about 9 trillion. So I'm just
Nice.
speaking to the U.S. market
U.S.
here.
Okay, so
Thanks for the
it's
question.
still only a point. You're saying.
That's right. On top of that, there's then family offices, which are much more difficult to measure. There are some large endowments, some pension funds, churches, and then family offices that have been buying hand over fist. I think the most notable in the press anyway has been the Bill and Melinda Gates Foundation, buying very large tracts and deploying hundreds of millions of capital into farmland. They see it the same as we do. It's it seems to be at least a good store of wealth. A good preservation mechanism.
So tell me, is the bear market, the 15 to 20% downtrend we've had in the markets in the last 2 weeks, is that good or bad for you?
We have seen a marked improvement in our website traffic. I'll say that. So I think in the last week,
maybe I'll go buy some farmland.
There you go. In the last week, I think our website traffic's up 35% week over week.
Wow.
So that's a pretty meaningful jump. And fear and panic is never good. And we don't want anybody to invest on the website out of fear and panic. We do, see that market volatility highlights to people, I wonder if there are other assets out there that are less volatile. And we definitely think that farmland is one of those.
It's really interesting. It's almost like you're getting the hard asset underneath it with no leverage, but almost like, it's could you equate it to a high yield bond, but safer?
And
how long before you think, like, if you were to reach scale, wouldn't that inherently drive prices up to the point where the investment, like if people are late to it and there's let's say there's other copycats that are coming out to copy what you're doing, and maybe they're a little less stringent on
we've seen that
on the due diligence front, and people are running, into this asset class, let's say retail investors become savvy about it and they start kind of piling in. Where do you see there being a point where it can't absorb the 3 trillion or so? Where do you see, like, at 1 trillion?
We're a long way away. I think right now, $50 to $100 billion of farmland transacts every year, we think. So, even if we're taking down $1 billion a year, we're still a tiny player in the market. That's absolutely our goal, is to be there. But that does not seem to have a discernible impact on prices. I want to circle back to your bond question as well, because it's a fascinating one.
Yeah,
I do personally think about it as a bond. I invest, personally, in the farms on our platform under the same terms as our website users, and that's the way I look at it. Is here is a more like a tips or something where you have there is correlation to inflation. That's the one thing farmland is correlated to decently, is inflation. Everything else, like S&P, it's almost exactly zero in terms of correlation, but it does over time. You have some inflation hedge there. So that's helpful to think about. And as a bond, if you're thinking about investing in a bond, you're backed by a government or backed by a company. Here we're backed by a hard asset that produces something that, unless we all die, we will need. Right? No matter what happens in the world, we have to eat. And that's a pretty comforting thing to know about farmland as an investor. Is we're going to need the soil for a very long time.
I'm surprised that with technology and with the improvements in output per whatever, that we haven't seen the cash on cash, or at least the appreciation flatten. That's surprising to me, that there hasn't been any sort of, no massive bear markets where, like, there was maybe it's because you don't have the data all the way back, but maybe once machinery became much more prevalent. I don't know.
So for the actual underlying prices, we do have the data going much further back. It's the rent that's tough to put together. So we can see the long-term appreciation trends, and over 50 years, the appreciation, just half of the income component, right? Or half of the IRR component. The appreciation's been about 6% over the last 50 years.
It's amazing.
And you bring up a really great point, which is yield, not income yield, but crop yield.
Crop yield, yeah.
And that is an up and to the right chart. So you got supply and demand, right? So we have so many mouths to feed in the world, and that's growing every day at a pretty rapid clip. We have the amount of farmland, and that's shrinking every day. We lose 3 acres a minute in the United States of farmland.
And why is that?
Mostly development.
Development. Okay.
Cities are growing. We're using more and more land. So
okay.
So the basic economics are really easy to understand. Growing demand, limited and shrinking, very finite and shrinking supply.
And productivity is not keeping up with that.
You got it. So that's the other, it's supply and demand equation. That's the other big thing is productivity, crop yield in our case.
Yeah.
It saw a big jump around, mechanization, saw a big jump around genetic improvements and input improvements. So smart application of fertilizers, and has continued to curve upward for a really long time in a consistent manner. Just to feed the world, we've got and the stats 5 years old, but roughly double our output, our crop output in the next through 2050. So the next 30 years. So we need a hell of a lot of improvement in crop yields just to keep up. And even then, you still have the demand issue of the amount of farmland shrinking out there.
It's really interesting. It's really interesting. It's almost like a little mathematical model you could put together in terms of trying to get to your underlying. It sounds like the tailwinds behind the asset class are pretty strong, based on what you're telling me.
We would firmly agree with that.
Even with the genetic, non-organic, no, just kidding, no GMO. So yeah,
that's a whole other podcast.
Yeah, that's a whole. Yeah, we're here in San Francisco, so as you can imagine, the Whole Foods crowd and the genetic, it's very the organic crowd here is very strong.
It brings up a fascinating not conflict, but the yields of organic are far less
right
on a per acre basis than the yields of genetically modified crops. So in theory, if the world moved to 100% organic tomorrow, we wouldn't have enough food because you need to use more space to grow organic.
Right. That's really interesting. Yeah. And so, the genetic modified, all that stuff that's more resistant to parasites, can really dramatically increase yield, I assume. So
that's right. And again, we're not anti or pro.
No, I eat organic
or GMO.
I have my kombucha here. I'm very much in the Bay Area.
No, I mean, we just did an organic farm on the platform, a conversion farm where we're helping the farmer to bridge it into organic. So we're, even from a pure financial return perspective, we're believers.
Very cool. Anything else? Anything you would tell your younger self or the young listeners out there in terms of career, in terms of startups, anything that you'd like to share before we call it? Or about the startup in general that I didn't cover that you'd like to share?
Yeah, I think the big one is don't worry. Show up to work, and get there first and leave last. But worrying does no one any good. And I think probably earlier in my career, I did a lot of scenario analyses and a lot of thinking and worrying about what was going to come out the other side. And in reality, as long as you work hard and keep trying, you can stumble upon some luck every now and then.
Great. I love that. We'll end there. Thanks so much, Carter, for joining
us. Thank you.
And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, Patrick@wallstreetoasis.com. Until next time.